Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there's a company that I have been really fascinated in because of the suite of products they have. This is GraniteShares. And the thing that I've been looking at this year is like Nvidia mostly just goes up, 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 up. And GraniteShares has this ETF that is a 2x Nvidia, which basically is like, not only is it a rocket ship, it's like a bigger rocket ship. And I'm really curious about who's behind all this.
Yeah, I refer to this broader category as hot sauce because a lot of portfolios, in the middle of the portfolio, it's pretty dull. You buy and hold some low-cost beta vanilla index funds and you have to wait 35 years. So people like to have a little fun on the outside, speculate. And so single stock ETFs are one of many varieties of hot sauce, and they're taking off. The assets in these have doubled this year. We're only halfway through and they've already doubled. Probably the big hit is NVDL, which is the GraniteShares 2x Long NVDA, which now has, Joel, $4 billion in assets. That is big time money right there. And there's a lot of this is them trial and error. They launch different stocks and some take off, some don't. So not all these are a hit, but there's been a couple breakouts that I think have shown people, hey, this is a category that is here to stay. And it's an interesting one. I think for people on the outside, sometimes they scratch their heads like, who needs that? But the people have spoken. There's definitely an audience for this.
Joining us on this episode, Will Rhind, CEO and founder of GraniteShares. Also worth mentioning, this episode was recorded on June 24th as NVIDIA had kind of a down day. This time on Trillions, 2x single stock ETFs. Will, welcome to Trillions.
Thank you.
How is this not gambling?
Well, I think that, with anything that's leveraged, there's an element clearly of speculation depending on who's using it. But underneath the leverage, you're talking about real companies. And in the case of Nvidia, this has become the most important stock in the market, overtook Apple and Microsoft very recently to become the world's most valuable company. So on the one hand, leverage is probably the oldest concept that we have in finance, borrowing money to obtain more notional exposure. But this is done in a very sort of modern way by putting it in the ETF wrapper, giving people institutionally priced leverage, but with the access, the ease of access, the efficiency of the ETF wrapper.
How do you think Jack Bogle would feel about what you offer?
I'm not sure he would be the biggest fan. But it's funny because, I don't know if you were about to say this, Eric, but one of his big things from day one was he was bearish, or he did not like ETFs, period.
Yeah, we know that.
Because of people's ability to trade them.
Yeah.
And it's precisely that this group of customers, or our group of customers, it's precisely that element that they love. So it's, very perhaps contradictory or different to the buy and hold crowd. It's not something that they subscribe to, but there's a massive now amount of people, and increasingly so, that want to be self-directed, who are self-directed, and want to trade.
Is there anything that Will makes that is not rated R or red light?
Sure. They have a gold ETF, for example, that would be green light, to be honest. So I think some of the more recent ETFs that Will has put out have been these sort of more red light ETFs. But back to Bogle, he had problems with like 70% of what Vanguard offered. He was pretty brutal to everybody. But I think one of the things I try to explain to people about these is when I show my pie chart of like a modern portfolio, 85% cheap beta, boring, wait 35 years, and then like 10, 15% hot sauce, is that the hot sauce can actually have a behavioral purpose to it. If it keeps you from touching the 85%, right? So, because compounding returns are where it's at. That is the magic that we're all here for. But you can't touch it. So to give your idle hand something to do and speculate, sometimes you win, sometimes you lose. If that distracts you, that's a behavioral hack to me in a way. So I do think you could argue there's actually a Boglean purpose. He would say, well, why do you need to do that? But people are human. They like to speculate. Thematic ETFs I put in this category. ARK is a great example. So I'm fine with it. And I think, you can gamble on sports. You can gamble. Stock investing is kind of gambling. So I'm fine with it. I think it's, these things have a small percentage of the assets too. If they took over, it'd be kind of weird. But you have like your own little niche, and you are in what is very valuable these days, which is a VFZ, a Vanguard-free zone. So he never has to worry about Vanguard coming in and like ruining life in that category. Yeah. So that's got to be nice, right?
Well, I mean, it's something as, an independent issuer that clearly you need to be able to provide products that, frankly, the larger companies like Vanguard don't. Because when you're independent, it's the sort of boutique argument versus the big box store. So if you're trying to be a big box store but on a boutique budget, it's not going to work. So you have to be offering something different, and ideally something that you just can't get from those big players. And that's where companies like us come into play, that we offer things that are unique. And with something like leveraged single stocks, I mean, this is a new category that we pioneered. And leverage on single companies, in my opinion, is more intuitive than some of the other applications. But leveraged ETFs have been around for a long time. You've been able to trade leveraged ETFs on broad equity benchmarks, fixed income benchmarks, commodity benchmarks, even individual commodities. So this is really just an extension of that trend.
You have like 13 now of these single stock leveraged ETFs. Where did it all start? What was the one that you were like, oh my God, we have to do this?
So we got to rewind a little bit because we actually started this in Europe in 2019. And the reason we did that was that when I started GraniteShares 7 years ago, in the US, there were only 2 companies that could do leveraged ETFs, period, in the United States. So we couldn't do leveraged ETFs even if we wanted to at that time. That was a weird sort of government exemption that existed at that time. It no longer does. So
that was an SEC thing?
Correct. That was when the old sort of era was under exemptive relief. And there was a thing called exemptive relief, an exemption that was given to 2 companies and then not given to anybody else.
ProShares and Direction.
Yeah, there you go. And then fast forward a few years, we thought the idea was really good, but we couldn't do it in the US. So we started in Europe, and we have a platform in Europe where we offer over 100 products on different exchanges in every major country. So we started doing it there. In that time, the regulation here changed, and this exemptive relief or this exemptive regime went away and was replaced by a generic rule update that everybody nicknames the ETF rule. And what that effectively allowed is any company to do leveraged ETFs, obviously with some caveats. 2x is the maximum amount of leverage that you can do. But that opened the door for us to then bring leveraged single stocks, which we've been doing in Europe, here in the US.
And in Europe, Joel, they've got 3x Nvidia. They really party over there.
Which we'll come back to.
But Ethan on my team, sometimes we joke about that because they've got like 5x the Qs, 3x Nvidia, 5x AI. And we feel like it's kind of wasted on that crowd. Like, it's the American gambling degenerate mindset that would really have fun with those products. Maybe that's why the SEC limits it to 2x, because they know that these would probably fly off the shelves. But still, when you design these products, you put them out there, it looks to me like the ones that sell are the ones connected to stocks that are like see the most trading. Nvidia, Tesla, we ran a study. It looked like they're like maybe 80% of the market share of all single stock ETFs, even though they probably cover 50 stocks. But those 2 companies are like the majority of them. Is that just because people just love trading those 2 names? And if you can make putting on a different trade around them easier to me, sort of like a parlay, I'm going to trade that. Whereas Microsoft, I'm not that interested in that stock. It's not that volatile. It's not that hot. Is that why those sell?
In a way, I think I would add in one more thing to that, which is less quantitative, more qualitative. I'd say it's about the enthusiasm for the stock at the given time. And enthusiasm is a concept that you can't really sort of measure as such. But my example is Nvidia is the stock today that has all the enthusiasm, and Tesla, which you mentioned, is the second most popular. However, if we were talking about, or we were having this conversation 3 years ago, I would argue that we'd be talking about Tesla being the most popular because there was the most enthusiasm at that time for that stock. In Europe, we've seen, where we have a lot more of these products, we've seen huge amount of enthusiasm for companies like NIO, for example, which is another EV car manufacturer from China. Less so these days, of course, as that has moved on into AI.
Yeah.
And so I think
the market's matured slightly, and there's a little bit more competition for NIO, et cetera, right? Yeah.
Exactly. I think it reflects, the two biggest trends in my mind of this year have been AI and cryptocurrency. So naturally, in our product offering, the two biggest products and the most sort of activity and enthusiasm we've seen are for Nvidia, and we have Coinbase, 2x Coinbase. So that's kind of where we've seen that enthusiasm. And to Eric's point, that it hasn't been necessarily for companies like Microsoft, because arguably that was, maybe sort of 12 to 18 months ago when that stock kind of made a big move. But again, I think it's really down to what investors care about at that time.
I don't think we rewound the clock all the way there. What was the one that made you go, we got to do this?
I don't know if it was one per se. I think it was more the learnings from what we'd been doing in Europe, where we have more of a platform-based approach. And I think kind of what we're all dancing around is this concept of, okay, tech works. That's something that people like. There's a lot of enthusiasm for certain tech companies. And so when we launched here, we launched with a lot of the large tech names, but we did try and do some things that were different. So at the time, the reason why we did a 2x Coinbase was because there was no crypto, I should be specific, no spot Bitcoin ETF, which was a huge thing that, Eric's covered for ad nauseum for the last few years.
Yeah, he knows all too well.
Exactly. But, that was kind of a way to bring exposure to Bitcoin / cryptocurrency, but also with leverage, because there was no way to obtain leverage on that. So Alibaba is another one that we have where, again, it wasn't necessarily that there was the most enthusiasm for Alibaba as a stock, but it was a way to give people exposure to Chinese tech, in a very concentrated way that didn't exist.
And so let's go over how this happens, because you use swap contracts, right?
Yes.
And let me just, for anybody listening, do you remember the scene in The Big Short when Michael Burry wants to bet against the housing market?
Yes.
He can't
figure it out.
So you go to Goldman and they make you, it's like a bar bet, but more formal. This is all you're doing, right? You're basically being Michael Burry. You're going to these big banks and you're making these daily bar bets. And that's the legwork you're doing that somebody at home can hit buy, and all of a sudden they now have this swap contract bet. Is that about right?
Yeah, that's the instrument itself, but it's actually a kind of a much simpler concept, which is it's just financing. So it's using the balance sheet of a big bank to effectively lend the fund money to take an increased exposure on a particular stock. And in order to do that, you need to have a bank that has a balance sheet and is in a position to be able to make that financing or lend that money.
So to me, this is in a weird way, we talk about ETFs democratizing investing. In a way, that's democratizing that Michael Burry move. Most people do not get access to JP Morgan's swap desk. So
exactly.
In a way, this is all part of the same theme, which is you click a button and things happen. And in this case, it's this swap contract.
Yeah, and I think it's perhaps even more fundamental than that, which is it's democratizing access to margin and institutional price leverage. So the same price of leverage that we're getting delivering via the ETF is not the same price that you're getting at in your margin account at a Fidelity or Schwab, etc. And so again, it's a classic case of the ETF disrupting an existing mechanism that's been used by the banks and broker-dealers, for many, many years, but making the whole process a lot more efficient, a lot more cheaper.
Because you have a platform, I'm curious, that allows you to basically see who's using these perhaps more than other people. Is this, it clearly has an audience for traders, professional ones, institutional ones, but obviously there's, because of the popularity and the enthusiasm for these companies, like the retail crowd and the Redditors of the world would feast on this. Can you tell who's using it?
To a certain extent. So I think like any ETF manager, we're disintermediated always by two entities, which is the stock exchange on one hand and the brokerage that ultimately, has the transaction or handles the transaction for the customer. There's something called the 13F report, which is a regulatory report that we can look at that gives some, analysis or some look through into the shareholder base. It's not perfect, and it's a once a quarter snapshot. But what I can tell you is that I think like any successful ETF, it's always a spectrum. So you have retail investors clearly on one hand of the barbell, and then you have some of the world's most sophisticated hedge funds and proprietary trading firms, on the other hand, and probably everybody in between. So the other interesting aspect to this is that when you have a company like Nvidia has not just appeal with Reddit retail investors, right? This is a company, and this is why I say, so repeat, this has become the world's most important company. This has true global appeal. So if you're in Japan, or if you're in Korea, or if you're in South America somewhere, and you want exposure to that company, you can only get that in the US stock market. And therefore, you can only get the leveraged version of NVIDIA through our product, NVDL, here in the US. So providing your broker has access, then you access the market. And increasingly, we're also seeing this trend as well, whereby markets around the world are becoming more connected. Individuals are becoming more interconnected through technology. The first market they look to outside of their home market, and typically the home market may or may not be that developed, is the US market. And the reason why the US market is because the US market has performed very well. Why? Because of some of these stocks like NVIDIA.
I know. They're hot stocks. NVIDIA is now trading 4 times any other stock. Speaking of trading, listen to this stat, Joel. So even an NVDL is probably at $4 billion, maybe right around in the top 250 ETFs by assets. It's in the top 10 regularly in trading. So today, it's already traded $1.5 billion as of whatever time it is, 2:30 p.m. today. That's more than, ready? General Motors, Berkshire, Dell Computer, right? These are massive names.
How does it compare with SPY, which would be day in, day out number one?
Yeah, so as of right now, SPY has traded $13 billion, and his is $1.5 billion. Now, that is a pretty big gap, but everything's a big gap from SPY in the Qs.
Right.
But $1.5 billion puts you ninth. That's above HYG, above XLF. These are some big legendary names that.
But also, Eric, on SPY, remember that NVDL is, like I said, is $4 billion. SPY is over $500 billion.
Yeah.
Right? I mean, the difference in size is monumental.
But just getting yourself, IBIT is in the top 22, and that's obviously very impressive. It's hard to get on this leaderboard. ARK did it for a couple years there. So anytime an outsider can come in on the volume list and be right there with those legendary spider sectors, and it's a major feat. And when you have volume, then you get bigger fish. Volume's like chumming the water for big fish.
So it's a very interesting business model, and it's feels like you found a corner of the ETF universe that was more or less kind of open enough that you could come in and make a name for yourself. I'm curious though, what are the limitations? Can you go to BlackRock and say, I'm going to take IBIT and 2x it?
Well, this is actually a really good question. So in theory, yes. You can, again, remember the concept of leverage is the most basic concept in finance. It's just borrowing money to get an increased exposure to a given security. So in theory, you can leverage anything. What we have to be careful of or mindful of is that with an ETF, it's open-ended. And therefore, there has to be a scale aspect to it. And part of that means that counterparties, swap counterparties, investment banks have to be able to continuously finance and provide more exposure to it. So a better example might be something like a GameStop or an AMC, where, as you may or may not imagine, we get a lot of requests for these on a daily, if not intraday basis. Now, the problem is, in theory...
Is that from Roaring Kitty or other people?
That's from all sorts of people.
That's from his litter.
All sorts of people. On the one hand, yes, it's easy to provide some leverage against that. The harder aspect is how much and for how long. And so that kind of is really at the core of how we think about building these products for the longer term, and not just a flash in the pan whereby we might be able to provide $20 million of capacity, but if somebody wants 100, then we have no way to deliver on that.
But IBIT would be one that, back to your enthusiasm, like there's enthusiasm for it.
Correct. And so providing that we could provide or get leverage against that, then yes, you could provide it. It's just a question of how much we'd be able to get would really be the key question.
Joel, ready for some trivia? There's 13,000...
I feel like you're going to give it to me no matter what, but yes, okay, now I'm ready.
There's 11,700 ETFs in the world.
Okay. The world.
World. What is
Does that include exchange-traded products?
Yes.
Okay. All right.
Yes. What is the top performer year to date? I'll give you a hint. It came up already.
Nvidia 2X.
3X.
3X. Okay.
Guess how much it's up year to date?
Well, like 500%?
Double. 1,000. You're up 1,000%. It's not even June 30th.
Yeah.
That's pretty crazy. Now, guess what the worst performing ETF is year to date?
Tesla short, actually. No?
No.
Nvidia
the
3X short.
3X Nvidia.
So there is a negative.
Yes.
Which that was going to be my next question is, when you bring one of these into the world, do you have to think about, let's call that the yin, do you have to think about the yang simultaneously? Because for every bull, there's going to be somebody who's like, I'll take the other side of that bet.
We do. Now, it doesn't
but
automatically...
You're not doing that in the U.S.
We do for some. Now, part of the reason is first of all, launching ETFs and maintaining them is very expensive. So that's really the main reason. So you have to be conscious of the fact that at the end of the day, for us, it's an asset management vehicle, meaning we don't get paid or compensated for the turnover, for the volume, anything like that. It's purely on the management fee. So it has to be something that we can generate management fees from over time. The market is naturally long.
An example of that, from what I'm seeing, is you can go long Amazon, long Microsoft, but you're not going to short those.
We haven't bought a short version of that to market.
Okay.
And there's not really a sort of a great reason for that. But we have NVD, which is our 2X short Nvidia.
Right.
And, that's traded 53 million shares today already, which is, a huge amount of volume for a stock that, again, has performed very poorly up until the last few days, where Nvidia has gone through a bit of a correction. So, again, typically we try and bring a short if we think it makes sense in the context of these stocks. We have a Tesla short as well as a Tesla long. But it's not always the case.
That one makes sense to me because there's been so many Tesla haters, Elon haters through the years. It's like you can give the people who are the fans something to trade, but you can also give the haters. But like there's just not that much palpable hatred for Microsoft really in the same way.
That's right. Yeah, it was always, as Eric knows, we have a gold ETF, and I've been involved in the gold market for many, many years. And there was always a saying, in the gold market that, people would be bearish on gold, but they were never prepared to short gold. And so it was sort of this idea that you could be, very sort of openly skeptical, but you were never that skeptical where you actually put your own money, to try and take the other side of it and short it. And I think there's a little bit of that in some of these stocks as well.
So you've got this line of single stock ETFs. Now you filed, now you can't talk about filing, so I'll explain as much as I can in the question. You filed for what you call yield boost. And the boost is all caps, by the way. That matters. Yield boost. Now, this is a new form of hot sauce about income, Joel. So Yield Max is the current issuer. Will is now Yield Boost. Up in Canada, they got Yield Maximizer, which, by the way, just recently changed their name from Yield Maximizer, where there's lowercase, to everything's uppercase. I've never seen that. It reminds me of...
They gotta maximize their punctuation.
Remember Idiocracy, Brondo?
Yeah.
The thirst mutilator. It has some similar vibes. But so this is like...
You can capture their attention better because you're yelling when it's all caps.
So anyway, these are giving you massive annual yields, like over 100%, right? So if a treasury is 5%, this would be 100%. So what you're doing is you're taking highly volatile ETFs like Bitcoin, like volatility itself, like the Qs, and then you write call options just out of the money, which people will pay a lot more for, premium for, because it's more likely to come due. So as an investor, you give up almost all your upside, but you get this massive influx of income. Is that the idea, and who are these for?
So I think first of all, the reason why this is something that we think is relevant or is a good idea is combining the two hottest trends really of this year, which is leverage and income, but income particularly through options. And yield boost, first and foremost, these are not leveraged products, and that's important to say because I think there'll be some confusion potentially around because the security that the option is written on is leveraged. That people say, oh, it's leveraged. It's not. So it's not a leveraged strategy. But the idea here is to be able to generate higher levels of income, options-based income that you can generate from clearly a non-leveraged strategy, again, in a market that doesn't exist today.
So YieldMax, every single one of their funds has inflows. And this is a company that came from the outside, and the fees are not cheap. So that tells you there is definitely some demand for this. But some people would push back and go, well, fine, I get like a YieldMax Tesla or Yield Boost Tesla, and I get all this income, like 80%, 100%, but I'm still down, even with the yield factored in because Tesla's down. I guess what's the point, or how much do you have to be sure or care that the stock goes up or down? Because does the yield matter if you're still down on a total return basis?
I think it will depend on the investor. But again, you're basically skirting on a very interesting now concept, which is how important are the different elements of a return? And should we always, or do we always need to think about total return as a construct that is based upon income and capital appreciation? And in other words, if we just rely on income alone, is that or can that be even a better way to go? And so an example would be take something like an annuity, right? If the whole concept of an annuity is you give up 100% of your principal day one and you receive a stream of cash flows, for the rest of your life, hopefully. Now, apply that to something like this, where you may not give up, or you're not giving up your principal day one, you're investing in something, you're getting income, stream of monthly cash flows typically, and those cash flows can be pretty significant. The price of the underlying or the NAV can go down, can go up, but it's not necessarily the concept, or it's not necessarily the case that it's designed to generate a certain level of capital appreciation in the same way as it's designed to manufacture income. And I think that's the sort of the fundamental difference. And, again, we have another ETF, nothing to do with leverage or options, but it's a classical income one where it's called HIPS. We pay a monthly yield. And in that particular fund, we've paid the same monthly distribution, cash distribution, for now over 6 years. And it's a 10% plus yielding product. The reason, or the way we get there, is because the underlying are things like MLPs, so pipeline infrastructure, they're REITs, business development companies. And although the portfolio clearly has potential for capital appreciation, an MLP is not a growth company. So it's just a fundamentally different asset. The main reason is all tax related, right? You get a huge amount of income at favorable tax rates. That's really the reason for buying an MLP. So for somebody that can lock in a 10% income, they might think, well, that trade-off is actually really good for me because I can then get 10% per annum. And although my underlying, the value of my portfolio can go down, value can go up, as long as I have my 10% income and that's locked in, I know that I'll have something at the end. And I think that, again, is sort of part of this concept that is increasingly, I think, going to be more popular with people, where the income is prioritized more than the capital appreciation.
It's interesting.
That's like reflective of the high rate world that we live in.
Exactly.
Though, right? So as long as rates stay where or elevated compared to where they've been, like that strategy totally works.
Yeah, and I think again, part of the reason I think that a lot of these strategies took off in the first place was because, on the converse, when you're in a very low interest rate environment, your traditional fixed income, doesn't work from an income perspective.
Right.
And the way that people were generating money from fixed income, since the rate rises, in early 2022, was through capital gains. So it was through selling the underlying as opposed to income.
Yeah.
It's interesting. We've also noticed this is an area where there's a lot of closures. It seems like, because you're not the only one. LeverageShares has some. They're launching their first ever. They're big in Europe. Rex, T-Rex is another one. RexShares. There's probably Direction has their own line of these. I mean, there's probably well over 150, but 10% of them catch, and then maybe 40% of them you want to. They're doing enough that you keep them alive, but this is going to be a high turnover area probably because we have noticed that a lot of the closed ETFs this year are ones that are young. And it seems like we're getting into a period where, especially in the hot sauce lane, people are like, look, we'll try all this stuff. If some of this sticks, we'll keep it. And then the rest will shut down. But that cycle might be getting shorter. I'm not saying this is good or bad. It's just the reality of the situation and the reality of how the core of the portfolio is pretty much taken over by Vanguard and BlackRock. And so you're going to find a lot of experimentation. And so that's going to mean some broken eggs where you just throw in the towel, close it up, look for something else.
Yeah, I mean, it goes back to, on the one hand, it goes back to a comment I made earlier, which is launching ETFs and managing ETFs is really expensive. Now, leaving that aside, the base economic sort of quest is that I think we're at a position now where there's no taboo about closing funds. And to your point, that the core of the portfolio is heavily dominated by, let's call them traditional or core-based ETFs. So therefore, the more innovation that you're going to see, people are going to try new things. But if they don't work out, I think there's just no taboo now about closing down products that don't work. And that's healthy for everybody. It's healthy for the market, for the ecosystem. And clearly, it allows people to innovate more, to be able to bring things out that do work.
We've also talked to people on the podcast who have had the right idea at the wrong time.
Yeah.
That happens too. And, that's, it's amazing when you look back in terms of some of the most successful ETFs, how they've sort of either traded hands a few times before really hitting, or the concept is closed down. I mean, a version of what we're talking about today, which is options-based income. One of my portfolio managers was working on, going back sort of 15 plus years, probably it was actually the first strategy that was in registration for doing this precise thing in the US market. Just couldn't get, I think it was 6 or 7 years with the SEC, just couldn't get it done. And, the regulator wasn't ready at that time for it. And it was a classic example of where you're way early, on a great idea.
Okay, as long as we're talking about regulators, when you talk to the SEC about a 3x or 5x ETF, which right now they cap it at 2, what do they say?
Well, we don't.
I was trying that
because the rule is 2x.
Okay. So is there any chance of challenging that?
Well, can't you do it in an ETN? Because RexShares has 3x, but no single stock. I think they're all 3x, like oil miners and stuff like. But there are 3x ETNs.
Yeah, so ETNs obviously come under a totally different set of regulation.
Why not do those?
Because we can't issue ETNs. Only banks can issue ETNs in the US. So the ETF is the fund world, and under the fund world, that's limited to 2x. Banks can issue ETNs because ETNs are not technically funds. They're debt securities issued by a bank, and therefore when the investor buys, they bear the full credit risk, the good faith and credit of whatever bank is issuing them. And obviously, if the bank goes bust, you're an unsecured creditor of that bank, as opposed to when you're an ETF, that pool of assets, which is in the ETF, is actually a segregated, bankruptcy remote pool of assets. So ETNs we can't do, unfortunately.
Right. But how would you go about challenging the 2x?
We certainly, honestly speaking, we haven't thought about it. I think, it's potentially something that evolves over time. Although, again, I don't know. It's not something that we've specifically had a conversation about. Although, like all these things, potentially that evolves over time.
Yeah. And speaking of an idea that didn't work back, but I almost feel like I could maybe try it again, is the two-way trades, like 2x Nvidia plus, or long Nvidia, short Tesla, or long gold, short Bitcoin.
And 2x that?
And you could even 2x it. I don't know, any thought of, because we call these package trades where you hit buy and then you put this trade on. And it just seems like there's some things that go against each other nicely that you could do. They tried them back in the day, maybe 2 different phases, but this was before we had this sort of like hot sauce boom.
I think that's an example of exactly what you were just talking about, which is this is where you're going to get innovation in the space, and people will bring out strategies like that. And if some, which I think, the key is a lot of these are performance based. So if the performance is there, I think you'll be able to attract assets. And if that performance stays consistent, you'll attract even more assets. Yeah. But it won't be the case for every strategy. Right. And so there'll be 1 or 2 that will perform really well. They'll attract a lot of assets. And then there'll be others that don't perform well.
What about something like QQQ, right? So we've been talking all about single stocks, but could you look at, something that historically has performed just sensationally well, the Qs, and think about bringing leverage to that?
We definitely could. The challenge there is that, remember I said that there were 2 companies that were allowed to do leverage, and so effectively had the market to themselves for a long, long time. So think about a world where they kind of covered most of the bases with levered products, 2x, 3x, Qs, SPY, major benchmarks.
So they got to get there first, basically.
Exactly.
Yeah, dude,
grew that market.
TQQQ, guess how much assets this has? This is a triple leveraged Qs. Guess the assets. His has 4.
20?
Yeah, good job, man. Look, I
hadn't looked. I didn't know.
Your ETF Sixth Sense is getting better. It's $23 billion. That's an enormous amount. And they charge 88 basis points on that. That is, we always say that those 2 leverage companies got a good little gig, and they're protected from Vanguard.
So, but they're there, and you can look at them and be like, "Is that something that I want to enter, or are they so? They have that such on lockdown that it's not worth your strategy gearing into their lane."
Again, you're kind of entering into a really interesting area of the ETF world, because it's not just about product development; it's about index licensing and access to intellectual property. Yeah. So I think that before I even answer that question, we wouldn't even be able to get the license for those indexes, let alone to be able to launch those strategies. So again, that's a very interesting area of the ETF world, where a lot of it comes down to who owns what properties and what intellectual property, and is able to sort of build a moat through access to certain benchmarks. Yeah. But leaving that aside, I think it would be difficult for us to compete on a like-for-like basis, because we would be adding no value effectively, other than maybe doing it for slightly less fees or something like that, which I don't think would be enough of a draw to get people in. I think that's why we're doing the approach we're doing, which is we're innovating in new categories like leveraged single stocks or yield boost, where we're able to bring completely new concepts to market. And we would prefer to own the new concepts than rather trying to compete with existing ones where it's not likely that we are going to have much success.
Yeah, totally makes sense.
So your second biggest ETF sort of sticks out now in this 2x world you've created is BAR, the gold ETF. I remember interviewing you for my first book, The Institutional ETF Toolbox, available on Amazon, at the World Gold Council. You were Mr. GLD. Then you launched a lower fee version of gold called BAR. And you even called your company GraniteShares. So you're like a gold guy, I think, at core. Bitcoin comes along. What's your take on that? Like, if you were talking to, I don't know, your uncle who was like, hey, what should I do? I do want something that protects me from the devaluation of currencies. Should I go into gold or Bitcoin? What would you tell them?
Well, I think that one thing to also point out is that we were one of the first people to register for a Bitcoin ETF, and it's an entrepreneurial story rather than a technical story. But when we were in the first, I think it was 2018, the SEC came around and said, "Nope, sorry, not going to happen," because of the ETF experience that I had, I being in the market for a long, long time. I knew that, hey, this could go on for a number of years, almost certainly going to cost a huge amount of money. And as a startup company at the time, just didn't have the resources to fight, the battle on that. So I think from my perspective, I've always kind of viewed our job as we're somewhat agnostic to the underlying assets that we're invested in. It's our job is to give people or provide products that people love. And if people want access to Bitcoin, it's our job to do that. If people want access to gold, it's our job to do that. So I personally don't own any Bitcoin. I don't have anything against it. It's just, I think for me, I've always sort of struggled with the fact that inherently there's no intrinsic value, and it's different fundamentally from gold. And so coming from the gold background, I feel like, okay, there's a cost clearly of owning gold, there's a cost of mining it, there's a cost of storing it, there's a cost of insuring it, there's a cost of transporting it. And I think that with Bitcoin, the thing that I always sort of struggle with is that once you've made up your mind, when you take something, any asset that has zero intrinsic value, once you make up your mind that the value is not zero, then it can be anything. So when look at the price, it's like, okay, it's $60,000. All right. It could be $1, 60,000, 500,000.
It's whatever I can sell it for.
Exactly.
But can you say the same thing about bar or gold?
Well,
just because some people wear it as jewelry, is that the argument?
No, I mean, it's a real thing that costs a lot of money to mine, to produce, to get the permitting. So there's a real kind of fundamental economic 101 principle around any kind of hard asset, and has been, for thousands of years. And again, people will, of course, go on about the amount of electricity costs and things to mine Bitcoin and the cost of the technology to do it. And I hear all of that. I think it's just that basic concept of, okay, if the intrinsic value is zero, once you've made up your mind that it's something other than zero, then it can be anything.
Final question. Favorite ETF ticker other than any of your own?
That is a great question. I know this is not necessarily the most the most sort of unique or
he's going to give us something good here. I can tell.
It's kind of a tie, but I think that the QQQ,
yeah,
and SPY,
yeah,
the three letter tickers are now kind of very rare. So they denote something that's a lot older. But I think that while there's not necessarily anything clever about the symbols themselves, what's good about them is they've represented or become to be sort of like Coca-Cola of ETFs
yeah,
for that particular category.
Yeah.
And that's cool. I think when always the test of a great ETF is when people know the ticker more than they know the actual strategy. And so I've heard stories, just one particular one that made me laugh, and why I thought of the Qs. I was recently in Japan just a few weeks ago, and I was talking to some investors there, and including somebody from Invesco. And Invesco, of course, is the issuer of the Qs. And he said that, well, we have a lot of issues with brand recognition in Asia because no one knows Invesco.
They know the Qs though.
and they said that, you go to a meeting and the client will say, oh, Invesco, we don't know who you are. And he said, oh, okay, well, we've got the Qs? I said, oh, I know the Qs. And so they know the Qs, but have no idea the company that represents it. I think that's a sign of when you made it as a ticker. If you're a ticker symbol that is looking for,
is more popular.
When you've made it in life.
We've never heard of you. We just know you're a product.
Exactly.
All right. Well, Ryan, thanks for joining us on Trillions.
Thank you so much. Absolute pleasure.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.